Hi everyone! So today we are looking at Hang Lung Properties, a Hong Kong listed property company with a large exposure to Chinese premium retail. The stock is currently trading at a very large discount to its NAV, but the story here is very different from my previous video on link rate. So in this video, we'll try to understand whether this discount represents an opportunity or whether the market is right to be cautious. To understand Hang Lung, we first need to separate the business properly. This is not exactly a REIT, and it is not only a mall landlord. The company has three main activities. The first one is property leasing, which is by far the core of the group. This includes retail malls, offices, serviced apartments, residential rental assets, and related income from investment properties, including car parks. The second activity is property sales, which is much smaller today, but still important to mention because it is something link rate doesn't really have. And the third activity is hotels, which is still small in the numbers, but strategically linked to the broader experience around the malls. The revenue mix makes this point very clear. In 2025, Hang Lung generated 9.95 billion Hong Kong dollar of revenue, and property leasing represented more than 94% of that revenue. Retail and malls leasing alone represented around 71% of group revenue, office leasing around 21%, while residential and serviced apartments, hotels and property sales were much smaller. So even if Hang Lung has several activities, the investment case is still mainly about the leasing portfolio. The second important point is the portfolio itself. Hang Lung owns around 195 billion Hong Kong dollar of investment properties, and the split is very different from link rate. Around 68% of the portfolio value is in Mainland China, and around 32% is in Hong Kong. With link rate, the core of the analysis was Hong Kong daily needs retail. With Hang Lung, I think the real core of the thesis is Mainland China premium retail. Hong Kong is still important, but it is not where I see the best long-term potential. The mainland portfolio is built around the 66 brand, with assets in cities like Shanghai, Wuxi, Jinan, Shenyang, Tianjin, Dalian, Kunming, Wuhan, and Hangzhou. Hang Lung has historically tried to build premium destinations with strong architecture, good locations, high-end brands, and a positioning much closer to luxury and lifestyle retail. Plaza 66 in Shanghai is probably the clearest example of that strategy. It brings together the main features of Hang Lung's premium positioning: luxury brands, polished architecture, good restaurants, and a retail experience focused on fashion, lifestyle, and status. That is why the trade mix matters. In the link rate video, the key point was that a large part of the Hong Kong portfolio was anchored in daily life: food and beverage, supermarkets, markets, services, personal care, medicine, and education. Hang Lung sits in another part of retail. In Mainland China, the mix is led by fashion and accessories, followed by food and beverage, lifestyle and entertainment. In Hong Kong, food and beverage is still the largest category, but the portfolio still has meaningful exposure to department stores, fashion, lifestyle, and other discretionary categories. So the difference is not only the tenant mix, it is also the role of the malls in people's daily life. Link's assets are more local and necessity-driven. Hang Long's assets depends more on destination retail, discretionary spending, and consumer confidence. Historically, that premium positioning was a strength. During the good years, luxury brands wanted the best locations, and Chinese consumers were spending heavily on handbags, watches, jewelry, fashion, and accessories. Hang Long benefited from that, but luxury is still cyclical. When the consumer feels rich, the model looks powerful. When the property market is weak, confidence drops, and people become more selective with spending. The same model becomes more fragile. This pressure helps explain Hang Long's weaker performance in recent years. The Chinese luxury consumer is still there, but the cycle has clearly turned. The same weakness is visible across the broader luxury sector, both in sales trends and in the share prices of companies like LVMH, Kering, and even Hermès, although Hermès has been much more resilient. For Hang Long, the link is direct. A large part of the portfolio depends on premium consumption and the willingness of wealthy consumers to spend again. There is also a change in what the premium customers want. Luxury consumers are not only looking for boutiques and products anymore. They also want restaurants, cafes, wellness, beauty, events, entertainment, hotels, and private space where they can spend time. This was a weak point for Hang Long before, because the historical model was more focused on luxury boutiques and product shopping. Hang Long seems aware of that. The group is trying to broaden the tenant mix with more food and beverage, lifestyle, personal care, beauty, wellness, entertainment, and service-oriented concepts. I think this is the right direction. A premium mall today needs to give customers a reason to stay, meet people, eat, attend events, and come back. But this transition takes time, and it doesn't fully protect the business if the macro environment remains weak. Before separating Mainland China and Hong Kong more clearly, we should look at the operating track record. The occupancy chart is the first useful signal. Occupancy increased from around 85% in 2015 to around 94% in 2025, which shows that Hang Long can still attract tenants across the portfolio. But occupancy alone doesn't tell us enough. A landlord can preserve occupancy by accepting softer rents, more incentives, more flexible lease terms, or slower rental growth. So the next step is to check whether high occupancy has translated into real revenue growth. This is where the revenue chart becomes more disturbing. Over 10 years, the group has not really shown growth. Revenue was around 8.9 billion Hong Kong dollar in 2015 and around 9.95 billion Hong Kong dollar in 2025. The 2016 peak is misleading because it was heavily boosted by property sales, so I wouldn't treat it as recurring revenue. After that, the group mostly stayed between 9 billion and 11 billion Hong Kong dollar. For a company that owns premium assets, has continued to invest in mainland China, and presents itself as a high-quality landlord, this top-line record is not especially strong. Net property income gives a cleaner view of a leasing engine, and the picture is a little better. It increased from around 5.7 billion Hong Kong dollar in 2015 to around 6.7 billion Hong Kong dollar in 2025. So the rental profit base is still larger than 10 years ago. But the growth is modest, and the peak was already reached in 2021 and 2023, above 7.4 billion Hong Kong dollar. Since then, the line has moved down. For me, this is one of the most important points in the operating section. Hang Lung owns good assets and keep high occupancy, but the numbers don't show strong pricing power. The core leasing business is under pressure, and the company has not been able to turn portfolio quality into meaningful income growth over the decade. This is why we need to look at the other activities separately. If leasing were growing strongly, hotels and property sales would be secondary details. But when the core rental engine is under pressure, these smaller segments matter more because they tell us whether Hang Lung has other sources of profit that can support the group. The hotel business is one of the main differences with link rates. Strategically, the logic is easy to understand. If you own a premium mall and you add a luxury hotel next to it, you can create a broader environment around the customer. A hotel guest can become a mall customer, a mall visitor can become a hotel customer. The whole project can feel more complete, more premium, and more like a destination. On paper, this fits well with a shift from pure luxury shopping toward a broader luxury experience. The financial result is much less convincing. The hotel segment has been loss-making in most recent years. There was a small profit in 2023, but losses returned in 2024 and 2025. The loss narrowed in 2025, which is better than 2024, but it was still a loss. So hotels can support the positioning of the assets and help create the full customer experience, but the numbers do not yet prove that this strategy creates meaningful profit for shareholders. Property sales are also different from link rate, and the chart is even more cyclical. Hang Lung has historically made money from this segment. In 2016 and 2017, property sales and development generated strong operating profit, but that was a very different environment. Since then, China's real estate market has gone through a major downturn. Buyer confidence is weak, competition is high, and development profits are much harder to generate. The chart shows the change very clearly. After 2017, the contribution from property sales collapsed. Since 2019, it has been small, and in several years, it has even been negative. One positive point is that Hang Lung is not positioned in low-quality, mass-market property. The group is more focused on higher-standard projects, often connected to its mixed-use developments. But even with this advantage, I struggle to see how this business could become a real profit engine for the group over the medium to long term. So the real question is the leasing portfolio. And even there, I wouldn't treat every asset in the same way. For me, the office portfolio is probably the weakest part of a recurring business. The assets themselves are not necessarily bad, but the market is difficult. In both Mainland China and Hong Kong, tenants are not only looking for location anymore. They are also looking very carefully at rental costs, flexibility, and cheaper alternatives. With oversupply in several office markets and strong competition between landlords, I don't see a lot of pricing power here. In a good scenario, office rental income may remain broadly stable. In a weaker scenario, it can still decline gradually. So for me, the upside case is not really in the office portfolio. Car parks are a different story. Hang Lung doesn't disclose a clean revenue split between malls and car parks, so I wouldn't present an exact number with too much confidence. But based on the portfolio structure and the number of parking spaces, car parks probably represent a small but meaningful part of a retail-related portfolio. Maybe around 7 to 10% depending on how we estimate it. So I wouldn't build a strong growth case around car parks, but I like them as defensive assets. So when I look at Hang Lung, the real debate is retail and more specifically the mainland premium mall portfolio. As we saw earlier, luxury and premium consumption are cyclical. Today the cycle is still weak, but I don't think Chinese premium consumption is permanently impaired. My view is that we may already be close to the bottom. There were some early signs of improvement at the beginning of the year, before the recent geopolitical shock around Iran. Oil prices and inflation expectations delayed the recovery scenario. So instead of expecting a quick rebound, I will now push the potential improvement more toward 2027 or 2028. Over a 10-year horizon, I'm still more confident on the Mainland China side of the portfolio. The recovery may take time, but this is where Hang Lung has the most upside if premium consumption gradually improves. Hong Kong is much more difficult for me. Hang Lung's Hong Kong assets are valuable, but I'm not confident about their long-term growth profile. They are more exposed to fashion, beauty, lifestyle, premium restaurants, and discretionary spending. That makes them more fragile in a weak consumer environment. The other problem is Shenzhen. Hong Kong residents can increasingly go to Shenzhen or nearby mainland cities for restaurants, services, leisure and shopping. Prices can be lower, the experience can be attractive, and the border is no longer the same barrier it used to be. For a defensive daily needs portfolio, this is a drag. For a discretionary retail portfolio, it is more serious. Tourism can help Hong Kong in the short term, especially in core areas, but I don't see an easy path for Hong Kong premium retail to return to the old model. For me, the mainland portfolio is where the recovery potential is. Hong Kong is where I would remain cautious. Now we have to look at the balance sheet, because this is where the story becomes more demanding. Net gearing was almost negligible in 2015, around 1%. By 2025, it was around 33%. So Hang Lung is no longer the same balance sheet story as 10 years ago. The group has more assets, more projects, and more debt attached to the platform. Part of this increase comes from the long build-out of the mainland portfolio. Hang Lung has spent years developing large mixed-use assets, adding hotels, offices, residential projects, and now smaller V3 extensions around existing malls. To be fair, real estate is a long-duration business. You can spend capital today and only see the full rental contribution several years later, once the asset is completed, opened, leased up, and stabilized. But even with that nuance, this is still something to monitor. The capital has already been committed, while the full income contribution is still partly in the future. On the charts, revenue remains volatile, net property income is below its previous peaks, and the recurring business has not yet shown a clear acceleration. Borrowing costs also matter. At the end of 2025, Hang Lung's debt was almost split between Hong Kong dollars and renminbi, with around 53% in Hong Kong dollar and 47% in RMB. So the company is still exposed to the US rate cycle through the Hong Kong dollar, but the RMB share is now large enough to reduce the pressure a little. In 2025, the average borrowing costs fell from 4.3% to 3.8%, partly helped by lower cost RMB debt. That is a good sign, but Hang Lung is also much more leveraged than before. So the absolute interest burden still matters. The share count is another point to watch. From 2015 to 2023, the number of shares outstanding was almost flat, around 4.5 billion shares. Then it increased in 2024 and 2025, reaching more than 5 billion shares. So what bothers me is the combination. Gearing is much higher than before, the share count has started to move up, and the additional capital invested in the business has not yet produced a strong improvement in the income statement. Maybe part of a return is simply delayed, and that will be normal for this kind of business. But from a shareholder perspective, the timing matters. Hang Lung needs these assets to move from capital invested to visible recurring income per share. At today's share price, the dividend yield is around 6.7%, which is not bad. But we have to analyze it correctly. Hang Lung Properties is not a REIT, so the company doesn't have an obligation to distribute a fixed percentage of its earnings. The dividend is decided by management and the board. What is interesting on this chart is that historically, Hang Lung still tended to distribute a large part of its underlying earnings. From 2015 to 2023, the dividend per share was very stable, between roughly 0.75 and 0.78 Hong Kong dollar. And the underlying payout ratio was often around 80%. This also tells us something about the group. Over the last 10 years, Hang Lung didn't really deliver strong growth. And because the growth was limited, the dividend remained mostly stable instead of compounding significantly. Then in 2024 and 2025, with the deterioration of the situation, management cut the dividend from 0.78 to 0.52 Hong Kong dollar per share. After the cut, the payout ratio remain close to 80% of underlying earnings. So the dividend reduction was mainly a reset to a lower level of earnings rather than a complete change in dividend policy. Now we can move to NAV per share. From a shareholder perspective, this chart is not very flattering. NAV per share was around 30 Hong Kong dollar in 2015. It moved above 31 Hong Kong dollar in the stronger years, but by 2025 it had declined to 26.6 Hong Kong dollar. So over 10 years, Hang Lung didn't really succeed in increasing net asset value per share. Even before the Chinese real estate crisis and the pressure on Hong Kong retail, the increase was not very strong. And after the crisis, the trend clearly moved in the wrong direction. The group invested in new properties, but so far these investments have not been enough to reverse the decline in NAV per share caused by weaker property values, the tougher retail environment, and the increase in the share count. The price to NAV chart is more interesting. Before the real estate crisis in China, Hang Lung was already trading at a large discount to NAV. From 2015 to 2022, the stock generally traded between roughly 0.45 and 0.65 times NAV. If we take the average, the market was valuing the company somewhere around 0.55 times NAV. So even before the crisis, the market was already applying a big discount to the company's stated asset value. And for me, this is not really surprising. Hang Lung had already struggled to convince the market that it could grow the business profitably. The asset base was valuable, but the growth was relatively flat in reality. What is more interesting today is the current level of a discount. Using today's share price and the 2025 NAV per share, Hang Lung trades at around 0.29 times NAV. That is very low even for a company that may have structural growth problems. So bottom line, Hang Lung is clearly not a clean defensive rate story like link rate. This is a more cyclical, more complicated, and probably riskier situation. The office portfolio is difficult. Hong Kong is not very attractive to me. Hotels are not profitable, property sales are unreliable. And the group has not really delivered strong growth over the last decade. But the valuation is very low. At around 0.3 times NAV, the market is already pricing in a lot of bad news. A simple way to picture it would be this. It is like buying a damaged house at 30% of the average value in the district. You know the house is not perfect, the structure is not great, the foundations are not especially reassuring, and maybe later you discover water infiltration in the walls. You should not expect massive rental growth from this house. Maybe the rent stays stable, maybe it grows 1 or 2% per year if things improve. But at that price, the situation can still become interesting. You repaint the facade, you clean the garden, you plant a few flowers outside, and if the neighborhood improves a little, another buyer may be willing to pay 50% of NAV instead of 30%. That alone would already imply a meaningful upside. For Hang Lung, the equivalent will be a modest recovery in Chinese premium consumption, a bottoming of the luxury cycle, and a market that becomes more willing to re-rate the mainland retail portfolio. There is also a currency angle. Because a large part of the portfolio is in mainland China, an appreciation of the RMB against the Hong Kong dollar will mechanically help the group's reported numbers in Hong Kong dollar terms. It will not change the quality of the assets, but it could support reported profits, NAV, and investor sentiment. So I wouldn't call Hang Lung a safe compounder, but at this price, with a dividend yield around 6.6% while waiting, I think there may be something to play here, as long as we accept what it is, a recovery story. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.